We can start, sir.
Good evening, Chinnsamy Ganesan sir, and a warm welcome to you. And we are very happy that you have accepted our request to be presenter for today's very important topic, because you are the expert in this field. We wished that it is only you who can do justice to this topic. Good evening, the participants, and also warm welcome to you all. As you all know, this is a 3-day series started yesterday with specific objective of improving the quality and also to do the disclosure responsibility without faith. Most of us, as yesterday's speaker was telling, we follow the accounting standards, but we are not doing the job of disclosure in our reports. This is one of the observations made at institute level also. And I was reading that article recently. So we thought at SIRC, every small and medium practitioners are alerted not to neglect the disclosure part of non-corporate entities. Many think that if it is followed enough, disclosure is not very vital. So that is where, at least me, I have fallen behind Chinnsamy Ganesan sir for almost 2-3 months to see that this topic is done. But because of various other issues, we could not have it in the last month itself. We know that it is the tax audit peak time now. Everybody is very tied up. But nevertheless, irrespective of the numbers, this recording will go a long way in helping the members. Many have told me that they would want to watch it on record mode after this is uploaded to the YouTube also. So with this is very important of this topic, that is impact analysis on tax audit of non-corporate entities with special reference to accounting standards and ICDS. So this is how the topic is coined for today. And before I hand over the proceedings to Chinnsamy Ganesan sir, who needs no introduction, but still it is our what's called a minimum respect that we should introduce him to the audience. The decency demands it. So I take the pleasure of introducing you, sir, briefly. Chinnsamy Ganesan sir started his practice as a chartered accountant in 1988. He was in personal practice till 2005. He then served as a director in Lovelock and Lewis network firm of PwC for 6 years, and as a partner in BSR and Co. LLP network of KPMG for 6 years in audit practice. He was the lead partner for many Indian and multinational companies and carried out audits, advisory on international financing reporting, international financial reporting, taxation, due diligence, and other assurance services. He is presently the senior partner and head of audit and assurance of Messrs. CNGSM and Associates LLP, Chennai, a firm with 10 partners and around 120 team members. He specializes in financial reporting, including Ind AS, IFRS, and US GAAP, company law matters, audit and taxation, and is a recipient of the Jewel of India Award for his role in financial services and Certificate of Excellence for his contribution in the field of financial services by International Business Council. Proud of you, sir. Once again, congratulations for the achievement, great achievement. And he has presented 950 plus papers at various seminars, workshops, and conferences, both in India and overseas, on these specialized topics. He has assisted 78 plus companies on Ind AS IFRS in India transition period. And he has also authored a quick reference on IFRS with model Q&A, the revised Schedule 6 Ready Reckoner, Ind AS quick referencer, and Ready Reckoner for financial statements under Schedule 3 to the Companies Act. Ganesan sir is also closely associated with the ICAI and is a guest faculty for all the 5 regional councils. He was co-opted member of the Accounting Standards Board of ICAI and the AS Transition Facilitation Group. He was also a co-opted member of the Ind-AS Implementation Committee of ICAI and the Auditing and Assurance Standards Board of ICAI. And he is also associated with many chambers of commerce like CII, FICCI, ASSOCHAM, universities, etc., banks and other institutions, including C&AG. He is advising many boards of Indian and multinational companies and is presently an independent director in the board of directors of Railtel Corporation of India Limited, a mini Ratna public sector undertaking under the Ministry of Railways. He is presently a co-opted member of Executive Committee of the Institute of Directors, Chennai, Academic Council of Shiv Nadar University, Board of Studies of the Department of Commerce and of the Shiv Nadar University, Board of Studies of the Department of Commerce of the University of Madras, Board of Studies of Department of Commerce in Tyagaraja College, Madurai. With this brief introduction and high-profile personality, I present before you, Mr. Chinnsamy Ganesan. Over to you, sir. You have not mentioned there your 34 years of experience. I am taking the liberty of presenting that he has put in 34 plus years of practice, both in profession for that matter. Over to you, sir.
Thank you, sir. At the outset, I apologize for my bad throat, which was for the past 2 days I am suffering. Maybe you may have a little bit of disturbance during the entire presentation. Apologies for that. My sincere thanks to the Vice Chairman and the Secretary for enabling this particular program, because he was chasing, Vice Chairman was chasing not only now, for the past 1 year he was chasing that we should have an exclusive workshop for small and medium practitioners as well as for small and medium enterprises, including non-corporate entities. That's what his idea, because 80 to 90% of the practices size of any auditor will be of non-corporate entities or maybe a smaller company. As far as the company is concerned, we cover a lot because of Companies Act, because of accounting standard, because of FRRB, technical review, etc., we cover. But these non-corporate entities, we never touch this on the accounting part for a simple reason. We believe that as far as the non-corporate entities are concerned, only filing of income tax returns is the requirement, and accordingly nothing else is there. Despite the fact we are actually doing the tax audit under the Income Tax Act, and as per the preface to the accounting standard, it says very clearly that if it is subjected to any audit, any enterprise which is carrying on business, commercial or industrial activity should also have complied with all the accounting standards. But unfortunately, we missed this. There is an effort which has been made by the Institute of Chartered Accountants of India. They have come out with a specimen format of the financial statement. I think that tomorrow, the day after tomorrow, I think that the faculty will be discussing that specimen and illustrative format of the financial statements as suggested by the guidance note. I also believe that even though it is not made mandatory, I have observed even in my office when we were discussing about whether to change our format to the new format suggested by the Institute for non-corporate entities, or we will stick on to our old T-column format, whatever we prepare, even from tally we extract and we retain that, whether that is enough, because it's after all for the purpose of only tax audit. That's the way in which we had discussion, because the level of effort which was required to prepare that particular format is little extra, and maybe we will not be paid for it because of non-corporate entities are normally pays very lesser fees and they may not be able to afford also. So we will understand that. But what we have concluded in our office is that this format is nothing great. This is what we are using for a small company, small private limited company, what you are using, the same format is being used. Only thing is, wherever the reference of company is coming in, we are going to give the reference of a non-corporate entity. Wherever we are talking about section 133 of the Companies Act, we will be talking about the accounting standard issued by the Institute of Chartered Accountants of India. But the biggest plus point which we have seen after a big debate between our partners and the staff who are in tax audit season, after a big debate, we have concluded that at least for major tax audit clients who are non-corporate entities, we should follow this revised format. For a simple reason, when you are following that format, automatically all the disclosures required under the accounting standard, which Vice Chairman was mentioning, normally being missed out for non-corporate entities, is automatically inbuilt in that format. One. Second, whatever disclosures in addition to that required for tax audit purposes under ICDS, income computation and disclosure, can also be very easily amended and put it in the proper space. So accordingly, in my view, even though it is little difficult to follow that particular format, maybe initial stage, everybody will feel that. And the pressure which we are having is also within the next 17 days, how we are going to complete all the tax audit with the revised format. With all those things, my only small suggestion is, at least for a bigger non-corporate entities within your portfolio, start using this in the current period, and next year onwards, you can automatically switch over to all the non-corporate entities in the subsequent period. So this is what we have decided in the current period for a simple reason. It helps you to ensure compliance. It helps you to ensure that there is no non-disclosure of a material information required by accounting standard or ICDS. This is my observation, and this is not only my observation. This is debated, deliberated. In fact, my partners have bounced on me saying that you are doing a lot of lecturing, so you are making it simple that to follow that format. And after my deliberation, and they have also gone into that, they felt that yes, there is a merit in what this 34-year practitioner is talking about. That's the way in which they have concluded. So maybe you can also take that from that point of view. And today's topic, when we are talking about, as we have classified this into 3 categories, what we are planning to have is basically 3-day session. On the 3-day session, what I have been asked to do is to talk about the impact analysis on tax audit, because that is going to be our entire work for the next 17 days. Hopefully, there will not be any extension of time with respect to the tax audit cases. And when we are talking about the impact analysis, I have split that into 2 categories. One, what is the impact relating to accounting standard and the disclosure required? Second is, if I follow the accounting standard in the preparation and presentation of financial statement for a non-corporate entity, how that will be different from income computation and disclosure standard? If it is different, what is the further work which I am supposed to do? And what type of adjustment is required in the tax audit form is what we are going to discuss. Okay. So to put that into this, I'm starting with a key principle for the entire discussion, is that whether accounting standard is applicable to non-corporate entities or not, this simple slide which you can consider or keeping it in your mind, in case if it is already discussed also, just I'm recapping this in a simple slide. You have to see whether the non-corporate entity is carrying on any business, industrial or commercial activity. In simple terms, I can say that whether they have any income from business or profession. If they are having, then we have to worry about the tax audit, because tax audit is applicable only if there is a business or profession. And secondly, if tax audit is applicable, then the accounting standards will also applicable subject to certain conditions. So if your non-corporate entity does not have this, they only having income from house property or capital gains or income from other sources, then you need not worry about this at all. But having discussed that we are trying to connect with the tax audit vis-a-vis what is our role as an auditor, tax auditor, I believe that majority of the clients to whom tax audit is being performed will automatically get into this particular scenario. Entities carrying on any business or industrial or commercial activity. So professional activity is also part of this. Now, whether that entity is preparing a general purpose financial statement. If I say yes, the question is whether income tax filing is general purpose financial statement. My understanding is yes, it's a general purpose financial statement. That is the reason why the guidance note on tax audit very clearly mentions that all the applicable accounting standards should be applied in the preparation of financial statement, which is subjected to tax audit because it's a general purpose financial statement. The next one is this general purpose financial statement, which is relating to an entity carrying on business, industrial or commercial activity, should be subjected to audit under any law. Suppose if the entity does not require to get its accounts audited under tax audit, then again nothing to worry. But if I say yes, it is subjected to audit under any law, then we have to comply with the accounting standard which are issued by the Institute of Chartered Accountants of India based on various levels, level 1, level 2, level 3, level 4. There are 4 levels which has been given, right? When we are talking about this particular aspect, subjected to audit under any law, let me stop for a moment. Audit under any law means anything including tax audit, right? Now, suppose if we are talking about a non-corporate entity, which is a not-for-profit organization, a trust, and the trust normally does not carry out any business, industrial or commercial activity. Suppose if the trust also carries on certain activities, for example, the inmates are manufacturing certain products and it's being sold in the market to raise funds for utilization in the charitable activity, not for any commercial activity, but there is an element of business activity, manufacturing and selling of the products by the inmates. Now the question is whether that non-corporate entity, which is a trust, should also get covered under the accounting standard. Because the trust may not come under 44AB, but it will get covered under section 12AA, right? Now, you are going to issue an audit report, and that has a small element of commercial activity just for the main purpose for which the trust has been established. The surplus is going to be utilized for charitable activity only. But even in that case, the guidance is that the trust has to apply all the applicable accounting standard. The trust should apply all the applicable accounting standard. Now the question comes is whether this application of the accounting standard for the trust is only for the business income or for the entire income. Please understand that whenever we are talking about application of accounting standard, it is for the financial statement as a whole. It is not for a section of the financial statement or for a line item of the financial statement. And accordingly, even though a slightest portion of the activity is business, commercial or industrial activity, the NGO should apply accounting standards in full for the entire financial statement. That is what is the guidance which we are having. Now the various other activity which we are doing, certification for our clients, compilation, they give a trial balance, we are converting that into a financial statement for the purpose of maybe giving to the investors, maybe giving to the bankers, or maybe giving to filing with the income tax department, etc. Whether that compilation without any audit, I'm saying without any audit because it's not subjected to tax audit. Whether the compilation or limited review, normally non-corporate entities will not have any limited review, but assuming that there is a requirement to do a limited review, or sometimes they are only asking to do a specific procedures on their particular element. For example, if they are asking to help reconciling the entire donations received vis-a-vis the bank statement, or maybe they are trying to help you, they are asking you to help them in doing the physical verification of their fixed assets, etc., or inventories, or stock audit, etc. In that case also, we are carrying out certain activity. Similarly, stock audit, forensic audit, very rare, and the audit of NPO we have already covered. In these scenarios, whether the accounting standards will be applicable. Again, please understand, this is subject to audit under any law. So if I talk about certification, it's not an audit, compilation is not an audit, limited review is not an audit, agreed upon procedure is not an audit, stock audit is also specific work, forensic audit is also specific work, audit of NPO may get covered provided there are certain commercial and industrial activity. Okay, don't think that for every work which we are doing for a non-corporate entities, we have to apply the accounting standard. Okay, that is one specific element. Okay, Panisam sir is asking a question. Please clarify whether the new format of financial statement is applicable to a charitable trust registered under section 12AB, running educational institution not involved in any commercial, industrial or business activity. If you see the guidance note, of course, tomorrow another faculty is going to cover in detail. If you see this, when we are talking about a non-corporate entity, we are worried about the format of the financial statement, which will be standardized. So if you are standardizing a particular thing, even for a non-profit organization, in my view, we can follow the same principle. Only thing is many of the items will not be applicable to them. Okay. But anyway, a detailed guidance will be available with the next day speaker. Otherwise, what will happen is I will be talking about his section also, and tomorrow it will look like a repetition of the work. This is just for you to understand the level in which the 4 classification of non-corporate entities are being done: level 1, level 2, level 3, level 4. And majority of our clients, if comes under tax audit, normally follows under either this category or either under this category, right? If you see this, okay, and this is actually both the conditions are cumulative conditions, both conditions you have to see. If we are looking at this particular classification, mostly we will be falling under level 3 or level 4 of the entities, because otherwise it goes more than 50 crore. Very few non-corporate entities will be having turnover of more than 50 crore. The moment they are crossing a particular limit, what will happen is the bankers will insist them to go for a corporate format. So they will ask them to get converted into a company. So now our problem is only with respect to level 3 and level 4. The interesting factor is level 3 and level 4, they have given a lot of exemptions from the accounting standards applicability. Plus, they have also given certain exemptions from disclosure, right? Level 1, all the accounting standards will be fully applied. So it will, you have to apply all the accounting standards with respect to this particular case, right? Now, the point relating to that is the turnover, how we will determine. Turnover is based on the previous year's audited financial statement immediately preceding the financial year. So not current year thing. Similarly, borrowing at any time during the previous year, not this current year. And of course, they should carry out economic activity, which should be commercial or industrial or business activity. Otherwise, accounting standards will not applicable. Let's go with this basic principle. Non-corporate entities and how the applicability works on. As I have said, Level 1 entities, all the accounting standards are applicable, no exemption even in disclosure. Level 2, there are some exemptions. Level 3 and level 4, certain accounting standard itself is said that not applicable. Let us look at the overall summary, because I don't want to spend more time on this because it's only a list which you can use it. After the end of the session, I will share this presentation to the organizers and they will be sharing with all the participants here. Now, if you see the various categories, level 2, level 3 and level 4, why level 1 is not there, it means level 1 is all the accounting standards are applicable. AS3 is cash flow statement. They have said that it's not at all applicable to any of level 2 or level 3 or level 4 of the non-corporate entities. So very simple way of understanding. AS10, property, plant and equipment. Disclosure, they have given certain exemptions in respect of level 3 and level 4 entities. AS11 also, there is an exemption from disclosure. AS11 is nothing but accounting for foreign currency transactions. AS15, here AS15, in all the three categories, level 2, level 3 and level 4, there is an exemption available. That exemption is very interesting. If the number of employees are less than 50, the company need not carry out any actuarial valuation for gratuity and leave encashment. They can simply work out actual liability basis and account for it. That's what AS15 exemption for all the three categories. It depends upon the number of employees and not based on just level alone. Then you have borrowing cost applicable. AS17 is segmental reporting, not at all applicable. AS18, here you have to be careful. Level 1 and level 2 non-corporate entities, reporting of related party transactions are applicable. Level 2 also it is applicable. That is more than 50 crore turnover if they are having, and borrowing is also beyond the threshold limit. It has to give the disclosure of the related party transaction. Whereas level 3 and level 4, there is no requirement to report under related party transaction AS18. It's actually a blessing. The reason is, when we are having a financial statement where there is a disclosure which has been made, and subsequently when we are completing our tax audit and sorry, and we are giving the disclosure under section 48(2)(b), payments made to related parties, I normally believe that there should be a reconciliation between what you disclose under section 48(2)(b) and what you are giving under AS18, because AS18 covers everything, including reimbursement, including purchase of fixed asset, capital received, loans received, etc. Everything is covered there. But 48(2)(b) is covering only the revenue expenditure. So to that extent, you should always see that what is given in the disclosure as per AS18, and from that, whether the numbers are being matched with the disclosure you are giving in 48(2)(b. If there are certain items which is omitted, that is not falling under section 48(2)(b. You should have a proper work paper, which we normally miss it because last minute rush, small and medium company, small and medium enterprise, everybody is coming at that last moment. You will be having the problem of missing it by oversight. My suggestion is level 2, be careful. Analyze what are all the entities which will be falling under level 2 for your client, from your client list. And for them, make one of the important point, cross-check 48(2)(b) with the AS18. Simple. AS19, leases, only disclosure exemptions are being given in respect of non-cancelable leases. AS20, earnings per share will definitely not applicable to a non-corporate entity because there is no number of shares which is outstanding, so not applicable. AS21 is for consolidation, so that is also not applicable. AS22, an interesting factor, it is applicable for level 1, level 2 and level 3 entities. Biggest relief they have given is level 4 entities. I believe in our list, which we are going to complete by 30th of September, maybe 60% will fall into level 4 entities. And the biggest worry which we will normally have is that the deferred tax accounting. Now they have said for level 4 entity, AS22 will apply only for guidance on current tax computation and accounting for current taxes. Deferred tax, you need not worry, that portion is not applicable for level 4 entity. So that is the biggest relief which we are having. 23 is again consolidation related associates, so not applicable. 24 is basically discontinued operation, that is also not applicable. AS 25 is interim financial reporting, that is also not applicable. AS 26 on intangible asset. Again, disclosure exemptions have been given for level 4 entities. 27, again, joint venture, consolidation, not applicable. 28, impairment of asset. Level 2 and level 3, they have given exemptions for disclosure. For level 4 non-corporate entity, AS 28 is not applicable. AS 29, relating to provision, contingent liability and contingent asset, they are applicable with certain exemptions. If you look at this, the simple way in which you can proceed with respect to the tax audit of a particular client and what would be the impact arising out of accounting standard, simple concept, prepare a simple checklist. Maybe you can copy paste this entire table which I have given in an Excel sheet. You have to only put the name of the client, whether applicable, not applicable, based on whether it's a level 1, level 2, level 3, level 4 entity. And with that, if you see level 4, maybe you will left out with only 10 to 12 accounting standard applicable to the particular client. And for that, what is the focus points you can give guidance to your team members? There ends the compliance relating to the accounting standard. Nothing more to worry on the compliance, because we are always believe that accounting standard is a nightmare. And when we are trying to do that, it creates a biggest issue for us, etc., etc. My belief is that if you follow a systematic approach, it makes life easier. The checklist approach is one of the systematic approach which you can use it on a simple basis. Now, that is what I was trying to say. A checklist approach is a better approach. When we are saying that a checklist approach is a better approach, I also have one suggestion, which we normally do. We have the balance sheet and profit and loss account of the non-corporate entity. And out of that, for each balance sheet line item or profit and loss account line item, what is the accounting standard which we have to apply? In the checklist itself, you can mention what is the financial line items which we have to concentrate and what is the audit procedure to be performed, or what is the exact work to be performed by your team member. For example, if I'm talking about revenue from operations or sales, let us take an example that this is an entity having exports. So what is your point of view? Accounting standard 9, revenue recognition is applicable. Level 1, level 2, level 3, level 4 are all applicable. Your client is level 4, it is applicable. Is there any exemption given for disclosure? No exemption for disclosure. And what is the specific work you have to do? What is the risk related to exports? One is whether the material which has been moved as of the year end has reached the customer's place, or the risk and rewards of ownership is not passed on. Then in that case, the sales has to be reversed. So when we are reversing the export sales, all the income relating to that should also be reversed. For example, duty drawback has to be reversed. Freight you might have provided for it, that should be reversed. Any other expenditure, clearing, forwarding, etc., that should also be reversed. So once you do this particular identification of the item, we call that as a cutoff procedure. The sales of the current period should be accounted in the current period. Sales of the next period should be accounted in the next year, right? Like this, for each of the financial line items linked with the accounting standard, with the checklist itself, what is the financial line item covered? and what is the risk involved in that, and what should be the audit procedure to be performed. Simple working paper, enough for ensuring that whatever is the impact arising out of the accounting standard in your tax audit has been taken care, right? So that is what I am trying to say that. And interestingly, when we are talking about this accounting standard, there is two aspects of accounting standard. One is there is an accounting element, another is disclosure requirement. Certain accounting standard also requires disclosure. Certain accounting standard requires disclosure alone. What does it mean? For example, if I are talking about borrowing cost, it requires an accounting and it also requires a disclosure. Both the requirement is coming in. There are some standards which are only purely disclosure related standard. For example, related party transaction. When we are talking about a level 3 entity, related party transactions applicable, right? When we are talking about the related party transaction disclosure, nothing is going to get affected as far as the financial statement is concerned. Only the presentation and disclosure will get impacted. At the same time, the disclosure also very, very important for us. Why it is important? If you see the accounting opinion to be formed with respect to the accounting standard, it talks about two aspects. Whether the accounting policy selected are in accordance with the accounting standard, whether the presentation and disclosure are in accordance with the accounting standard. And of course, the presentation of financial statement is now, that is what I am trying to say, whether the presentation is taken care of. The presentation will be automatically taken care of if you are using the format of the non-corporate entity given by the institute. Even though it is only recommendatory, I believe that it will help us to ensure that there is no issues relating to presentation. The second aspect is, for everything which you have done, whether accounting or presentation, the user should understand, user of the financial statement should understand what you have done. So to that extent, a disclosure is also required, right? So that is also whether it is properly done. That is the reason why I put that on the completion stage. It is at the planning stage, you are listing out, preparing a checklist, identifying the items covered, line item wise, what is the risk involved, what is the work to be done. It is a guidance. But at the completion stage, you are ensuring that what your team has done relating to accounting has been properly managed, and also presentation is also taken care, disclosure is also taken care, right? This is a simple way of having a checklist approach as far as the accounting standard for tax audit purposes is concerned. Now, having talked about the accounting standard, now we have to move on to the income computation and disclosure standard. The fundamental reason why I am talking about ICDS is, even though the accounting standards are for the preparation of the financial statements, there is an overriding principle which says, with respect to computation of income, you have to follow the Act, Income Tax Act. If there are certain items which are specifically disallowed, even though you have claimed that as an expenditure in your P&L or charged as an expenditure in your P&L, books you have done according to accounting standard, but for tax purposes, you have to go with the Act if there are specific disallowances. Similarly, Act has not given a specific disallowance, but income computation and disclosure standard requires certain items to be disallowed. A simple example for you to identify is, some companies will have this. For example, if it's a construction company, I have entered into contracts with various customers, and one of the contract which I am entering into is with a new customer. I'm entering with a new customer for the first time. So to ensure that I maintain the relationship, I offered a low quote. And the low quote, over a period of time, I will understand that this will result in a loss. Ultimately, I will end up with having a loss. Knowingly, I have done that. So what it says is that the foreseeable future losses, when you are completing the contract, say in the third year or fourth year, you will end up with having, say, for example, 20 lakhs of loss. It says on the first year itself, you have to estimate whether there will be any foreseeable future losses. 20 lakhs you are estimating as a loss. that the entire 20 lakhs has to be provided for in the first year itself. This is accounting standards 7 says construction contract. Similar to that is also there for your AS9 revenue recognition. If there is a foreseeable future losses, it should be estimated and provided for. But if you see the ICDS is very categorically says foreseeable future losses are not considered as a expenditure for your computation of taxable income. So there is a specific item, but this disallowance is not coming by the act. It is coming by ICDS 1. When ICDS 1 is talking about foreseeable future losses are not permitted, and it also gives the cross reference for ICDS on ICDS 3 on construction contract and ICDS 4 on revenue recognition. Wherever it goes, it mentions specifically that it is not to be considered as an expenditure. What they say is, when you are actually incurring the losses, claim that year on year, what is the total cost you have incurred and what is the actual billing you have done? What is the proportionate loss in the current period? Go with the same percentage of completion method, and you cannot charge it in one single year and get the claim, right? So the core principle is Act gives certain disallowances, and over and above that, ICDS gives certain disallowances, irrespective of the fact that you have accounted differently based on accounting standard. And accordingly, when we analyze the impact on tax audit, accounting standard prescription vis-a-vis what is the ICDS position, we have to compare both. And if there is a deviation, then the deviation should be quantified and offered as an income under ICDS. And of course, it forms part of your Form 3CD. If I'm not wrong, clause 13E requires the quantification, 13F requires the disclosure. It is mandatory for every non-corporate entity. Now, whether ICDS is really applicable to my client, even though I'm doing a tax audit, whether it is really applicable to me or to my client or not, there is a further guidance which we have to see, not from the accounting standard point of view, but from the applicability of ICDS point of view. So it goes without saying, we are talking about tax audit. So naturally, there is a PGBB which is there. Income from other sources also it is applicable, but we are not going to discuss about income from other sources. So business income or professional income is already there. Business profits or gains, whatever is there, we are having the applicability for the non-corporate entity, because under tax audit it is there. The question is, if it is not there, they don't have anything, but you are doing some audit for some reason, but not for tax audit, because tax audit, if you see, they will be carrying out your business. If I'm not carrying on any business, then ICDS is not at all applicable. Okay. Now, the second question is coming is, suppose if I carry on the business, what is the method of accounting which I use? Please see very carefully. It is not only business income, it is not only tax audit. It also makes it very, very clear whether the accounting method which you are using is mercantile or not. Lot of non-corporate entities follow cash basis of accounting. Hybrid system is not permitted. That's the reason why I'm trying to say cash basis or mercantile system. A lot of non-corporate entities still follow cash basis of accounting. Now we are saying whether the method of accounting is mercantile. If I say no, so cash basis of accounting means no ICDS is applicable. So you need not worry too much about filling the details relating to ICDS at all. You simply say that not applicable. Okay. Entire class 13 E, D, E, F, all the three will become not applicable for that particular entity because their method of accounting is not mercantile. Having said that, only a word of caution. When you are putting that not applicable, you also say the method of accounting as filled in your tax audit form is also cash basis and not mercantile basis. There you are filling mercantile basis, but you are saying not applicable, you will get into trouble. So please ensure that consistency is being maintained. Now the next question which we are having is that suppose if it is, yes, it's a mercantile system. The question comes is whether the assessee is an individual or HUF. Here also non-corporate entity can be any category, right? Individual, partnership, HUF, BOA, AOP, anything, right? But the selective question is whether it is individual or HUF. If I say it is individual or HUF, then the question comes is whether tax audit is applicable. If I say tax audit is applicable, sorry, not applicable. If I am saying no, this is an assessee is an individual and he is maintaining books of accounts in mercantile, he is carrying on business, but tax audit is not applicable. ICDS is also not applicable. Okay. Other than individuals and HUF, whether tax audit is applicable or not, okay, you are going to have ICDS applicable. So only for the purpose of identification, assessee is an individual or HUF. For all other categories of non-corporate entities, you have to be clear that whether tax audit is applicable or not, ICDS will be applicable. But only interesting point is the disclosure and quantification relating to ICDS will be coming only in tax audit report. What is my role? Because tax audit is not applicable for a partnership firm. What is my role as an auditor? I don't have any role. What is a client's role? Because ICDS is applicable, they should have quantified that number. If the assessing officer quantifies the number and applies that, there is a possibility of he considering that as a concealment of income, misreporting or underreporting, etc., possible, and we have to get going on that particular scenario. Then, okay, Pooja has asked the question, is accounting standard applicable to individuals subject to tax audit? I have already talked about. Accounting standards is applicable for every non-corporate entity, whether it individual, HUF, firm, AOP, IOP, BOI, partnership, everybody it will be applicable, provided that the first slide which I started with the core principle, carrying on business, commercial or industrial activity, preparing a general purpose financial statement, subjected to tax audit. So since you are talking about a client who is an individual having tax audit, automatically all the accounting standard will be applicable. But provided based on the levels which we have talked about, because that is a new guidance which came in the current year. Okay. Now, what is the interplay between ICDS and accounting standard? Why we have to worry about ICDS? The simple reason is there are certain principles which I wanted to say. ICDS is applicable only for computation and disclosure of income or expenditure under the Income Tax Act. What does it mean? It only guides you or prescribes you how you have to compute a particular income or particular expenditure and what is the disclosure which you have to make as per ICDS. That is the only purpose for which it is there. The name itself is called Income Computation and Disclosure Standard only. Whereas the accounting standards define not only disclosure, presentation, but it also defines what is income and what is expenditure, what is asset, what is liability, what is loss, what is gain. Everything is defined by accounting standard. Now you will understand the difference between these two, right? When I say what is income is defined, what is expenditure is defined, what is asset is defined, what is liability is defined by accounting standard, whereas ICDS defines is applicable only for computation and disclosure. very, very clear that ICDS cannot define this is income, this is expenditure, this is capital item, this is revenue item. ICDS cannot do that. It's not my view alone. The technical guidance on ICDS, in Income Computation and Disclosure Standard issued by the Institute, categorically said that the purpose of ICDS is only for computation of current tax and computation of disclosing the various aspects required in ICDS. It cannot go beyond its domain and say that this is an income, this is not an income. This should be part of the income, this should not be part of the income. They cannot say. That is what the technical guide says. The reason behind that, why the technical guide says and why we are talking about that, is very, very simple. There are case laws which are settled in various courts of law where they have said assessing officer considers certain items as income, whereas the court of law has said that it is not an income. Assessing officer has concluded that the income has accrued in the hands of the assessee. Courts have held that the actual date on which it is accruing on that is not yet happened. So whether those judicial pronouncements still holds good or not is very clearly coming out with respect to these two items in my view. So clear distinction. Accounting standard says this, and what is your requirement as far as the judicial pronouncement is concerned? Still that will guide. We will discuss this with selective examples during the course of considering each and every aspects of the accounting standard vis-a-vis the ICDS. Now, here the interesting point is ICDS will overrule the accounting standard in respect of computation. That is the reason why they have brought in ICDS. I do certain accounting principle and say that that is the accounting concept, you cannot disturb my income. That is the court cases held. Now I wanted to say, no, that is not possible. Court have held that, but I am prescribing that this has to be dealt with only like this. For example, when I said foreseeable future losses cannot be considered as part of an expenditure because they believe you are following percentage of completion method and the future losses cannot be adjusted in the current year. That is the way in which they are talking about computation. They are not talking about whether it's an expenditure or not. So in that case, accounting standard asks you to charge it as an expenditure, but ICDS want to add it back to the taxable income. So ICDS will overrule. But the interesting factor is the ICDS as well as accounting standards are requiring disclosure. Accordingly, what will happen? As per the accounting standard also, disclosures you have to make. As per ICDS also, there are certain disclosure which has to be made, right? This is the interplay between the accounting standard and the ICDS to start with as a core principle. Under which level, sir, if its turnover is 12 crore, please see the table which I am going to give. Automatically, you will have the answers for that. Now, let's go to the ICDS 1 accounting policy vis-a-vis what would be the impact on the tax audit arising out of it. The first is, we have talked about foreseeable future losses. One more issue also arises. That one more issue is mark-to-market losses. So I have a forward contract or I have a derivative. Normally in a non-corporate entity, derivative accounting will be very, very less. But when you have a forward contract, export-oriented units or import-oriented units, they will normally take the forward contract also to hedge their risk of losing heavily in case the prices are going up or down. Dollar prices are moving differently or the foreign currency rates are moving differently. So if they have taken the forward contract, accounting standard 11 requires you that you should estimate the mark-to-market loss of the forward contract and recognized as an expenditure in the current year. MTM losses has to be accounted for. But ICDS 1 accounting policy says mark-to-market losses are not losses. They are saying it is unrealized loss. So accordingly, this unrealized loss cannot be allowed under the Income Tax Act. So they say that it is not allowed under the Income Tax Act. And the problem which I am having is, okay, you are not allowed to mark-to-market losses, but I have mark-to-market gain in the current year. Last year, I have mark-to-market losses, you are not allowed. This year, I have mark-to-market gain because the forward contract has moved in a different, favorable to me. What you will do with that mark-to-market gain? The ICDS 1 was silent about it. We were worried losses will be added back, but gains will be taxed in the year in which you have accounted in the books of accounts. Fortunately, in the frequently asked questions issued by CBTT, this particular case has been raised and they have said same logic applicable to like a losses, gain will also have the similar footing. So that means mark-to-market gain also taxed only on settlement of the forward contract or realization of the forward contract and not on accrual basis, right? So fair enough. Now, foreseeable future losses we have already discussed, not permitted. There is one policy which they are saying you cannot change an accounting policy if there is a reasonable, unless there is a reasonable cost. But unfortunately, there is no reasonable cost which is defined. But my feeling is, if you are changing an accounting policy in accordance with the accounting standard, I believe that nothing to worry too much on that. Because in any court, even if there is a dispute comes in, the assessing officer, the appellate authorities will definitely consider that accounting principle should be generally accepted accounting principle. You cannot go on changing that. So if I am following an accounting policy on a reason which is permitted by the accounting standard, nothing to worry too much. So I have not seen any issues in the past 3-4 years with respect to the change in accounting policy. And this is one important aspect. And of course, this applies to accounting standard also. You are not complied with an ICDS. You are not complied with an accounting standard. But you wanted to say in the notes by saying we have not applied this accounting standard and the impact is not determinable. Whether that will cure the non-compliance will not. If you are certifying a financial statement, it should be complied with all the accounting standard. The moment I'm saying all the accounting standard, the related compliance has to be ensured by us. If it is not complied, then you cannot simply put that this particular standard is not complied, all other standards have been complied, not acceptable. Qualification or modification may be required. You may ask me a question, sir, non-corporate entities, what is the accounting standard which we have to worry too much? For example, if you are talking about accounting standard on forward contract or foreign currency transactions, client is a simple importer and exporter. Why should we worry too much on this? Client doesn't want to apply that particular standard. Our client doesn't want to charge depreciation as per accounting standard 10 based on useful life. He wanted to charge depreciation only based on Income Tax Act, Section 32 of the Income Tax Act. In all those cases, whether this is considered as a non-compliance. I have given 2 examples. One is not complying with the AS 11. Another is they are not using the economic useful life given as per AS 10. They are not determined. Now let us look at both. How this has to be dealt with. AS 11 is an accounting standard, and accordingly, when you are not complying with that, you have to necessarily say the company has not, the entity has not complied with the particular accounting standard and the impact is not quantifiable. But at the same time, similar standard is available in ICDS. In ICDS, if they are not complied with, you cannot say not quantifiable, then it may be a point for the assessing officer to adjust your taxable income. That is one thing which you have to keep it in your mind as far as AS 11 is concerned. When we are talking about AS 10, economic useful life, depreciation is not charged based on economic useful life, but charged based on the section 32 on block of asset basis WDV method. I have seen cases where non-corporate entities, maybe a partnership firm or a proprietary firm or an individual who is carrying on business, etc., they don't want to complicate too much. One for book purposes, one for tax purposes, they don't want to keep. So in that case, what type of issue which will arise when your depreciation is not in accordance with the accounting standard? Only if it is not in accordance with the accounting standard, there will be an issue. But what accounting standard says? It says this should be based on the estimated economic useful life of the asset. The moment I say it is based on the estimated economic useful life of the asset, I can even consider whether the block of asset method which I apply under section 32 is equivalent to the estimate of economic useful life. In my view, yes, because Income Tax Act also gives you similar understanding. That is the reason why that WDV method has come. Initially, WDV method is the rates which have been given in Companies Act Schedule 14. When Schedule 14 has been revised to Schedule 2 under the Companies Act 2013, then the entire concept of rate has been modified into the estimated economic useful life. So the idea behind even block of asset depreciation is also to ensure that it is only based on the estimated useful life. So you can write down depreciation has been provided on block of asset method under WDV as per rates provided under the Income Tax Act, section 32 of the Income Tax Act 1961. Add one more line. In the opinion of the management or in the opinion of the proprietor or partnership, preferably use the word management because you can copy paste for the other client also. In the opinion of the management, this will approximate to the estimated economic useful life of the asset. So that you are trying to say what I have provided is equivalent to estimated economic useful life. There ends the matter. Now, what would be the implication? Who will question you why you have not followed it? For a non-corporate entity, there is no Companies Act. There is no register of companies. And only person to whom you are filing this is the Income Tax Department. Income tax is not bothered about your book depreciation. It is bothered only about your IT depreciation. So still it is better to do it. But only difference between AS 11 also, they have not done something. But here we are doing little differently. How this is considered as acceptable, but AS 11 is not acceptable. AS 11 requires an accounting both under ICDS as well as AS 11. Whereas here depreciation is governed by section 32 of the Income Tax Act. When I am following section 32 of the Income Tax Act, which in my view is equivalent to or approximate to the estimated economic useful life, there ends the matter. So there is a difference between non-compliance and compliance with the disclosure, which is not having any impact on the computation. So that is one thing which you have to take into consideration. This, of course, it's only under disclosure, so I will skip on this. When it comes to inventory, ICDS 2, here the problem which we are having is how you are accounting the inventory or how you are estimating the value of the inventory is very important for you. Because the method of valuation for book purposes, method of valuation for income tax purposes are a little different. For two reasons. There is a concept called inclusive exclusive, which we will see little later. Accounting standard is not sorry. Accounting standard is not very particular about retail method. But if you see ICDS tells you that if the assessee is a trader, not a manufacturer, but a trader can use a retail method. What is retail method? What is my selling price minus what is my margin, gross margin. If I reduce, that brings me to the cost, right? So accordingly, start with the selling price, reduce your profit margin. Profit margin is gross profit margin, not net profit margin. Gross profit margin, then you will arrive at your inventory cost. You can use this. I always believe that making life easier is a better way, not to complicate things too much. Even when we are discussing certain issues, people will think more and more complicated in respect of a particular issue. But if you find the solution will be very simple. And accordingly, you need not go with weighted average method, first in, first out method, or whatever other method. You can still use a retail method. But at the same time, you should also see, is there any risk associated with the retail method? One risk which I believe is associated with the retail method is that your valuation is available with the assessing officer. Your gross margin is also available with the assessing officer because under Form 3CD, there is a clause on ratios, clause 40 if I am not wrong. In accounting ratio, you are also going to give gross profit ratio. The assessing officer knows that you are having, say, 20% margin. So your cost when you are starting with the selling price, the percentage you have to reduce only 20%. If you are reducing 40%, then the 20% the assessing officer can simply say that you have undervalued your inventory and accordingly, I will add it back. So the information is fully available with the assessing officer and accordingly, whenever two informations are available with the assessing officer, please ensure that consistency is being maintained. That's the only additional check. Otherwise, retail method is the simplest way of doing things. The second complexity with respect to this, again for non-corporate entities, I have a different prescription which I follow, but I'm just going to give both the options which are available. Inclusive method, exclusive method, what it says, for book purposes, when I value inventory at my cost. So cost means what is the taxes which are refundable or adjustable or recoverable from the department is excluded. GST, one of such a cost, because what is the purchase GST paid on purchases, I can take input credit on that, maybe 100% or maybe based on some other specific requirement, proportionate or whatever. But my feeling is you are going to have a refundable duty. Because it's a refundable duty, you cannot add it to your cost. It should be considered as part of your asset and not as part of your inventory cost. Accordingly, when I value my inventory, I will not add this figure. For example, the product purchase price is 100 rupees, 18 rupees is a GST, 118 I have paid. In my books, I account purchases 100, GST input credit 18 to my trade payable. So 100 is sitting in my purchases or expenditure. Closing stock when I value, I should consider out of that 100, whether 100% is sold or 50% is sold or 20% is sold, assuming that 100% is not sold, just for the purpose of making it life easier. 100 rupees I have purchased, I have not sold anything. So closing stock should also be 100 only, right? Then only your cost incurred and your closing stock will match. You will not charge any expenditure or offer any income. This is a method, we call it as an exclusive method. Unfortunately, there is a section called 145 capital A under the Income Tax Act. And again, ICDS 2 is also talking about this, where they have said, for the purposes of income tax, inventory should be valued inclusive of all the taxes. The question is whether it is a computation rule or it is an accounting rule. It is not an accounting rule. They are saying it's a computation rule. Because the computation rule comes in, ICDS will overrule accounting standard. So book purposes, I will use 100. For ICDS, I have to see what is the GST on this 100, 18. I have to add that 18 also as closing stock. In other words, I will offer 18 rupees as an income, even though I have not earned anything. What will happen to the next year? Whether this is a permanent loss? No. 18 is the loss in the current year. But next year, when I am going to claim that, since I have paid tax on 18 already, I am entitled to take that as my opening stock 118, not 100 for income tax purposes, right? So it is only a timing difference. You have to add it and claim it when you are actually disposed of that particular item. The rule seems to be very easy. In a non-corporate entity, the problem is if I do this valuation, inventory valuation, and then I add up the taxes which are refundable, arriving at what is this? The difference between these two has to be offered under section 145 capital A and also cross-referred in ICDS 2 related quantification under class 13F. Fine. But whether the amount of the difference is reasonable for me or reasonable in sense, I'm offered to make the offering in the first year or I am not offered to offer. That is the only question. We have seen in many of the non-corporate entity cases, better to offer in the first year itself. Next year onwards, it's a reversal of that cumulative impact. So for example, last year 100 rupees is a tax, 18 rupees is added. This year I claim that 18 rupees, but the stock has gone to 115. Another 9 rupees might have been paid, but the 9 rupees will get allowed in the next year. This is the way in which we consider. But we don't consider it only because of ICDS. Even when we have done 145 capital A, we used to disclose that as part of it. This is what our firm follows. We have convinced our clients that it's only a timing difference. Let's go ahead with that. Client is also not feeling the pinch. But starting from the scratch, sometimes it may be worrisome for a client. I have to pay tax which I have not realized. In that case, there comes handy the technical guidance on ICDS, which cross-refers to the guidance given in tax audit under section 44 AB. Institute has given a tax audit guidance note. What is referred there, they have cross-referred here. And in the cross-reference, what they are talking about is that even if you are following inclusive method or exclusive method, the impact for tax purposes is revenue neutral. That means the profit will not go up, the profit will not come down. It's safe, is what they are talking about. Let's look at the same example, how they are talking about it. When we were worried, 100 rupees I have purchased, 118 I am showing as a closing stock. I have not realized anything, but I am paying tax on 18 rupees. What they say is, this 18 rupees is your tax expenditure towards GST expenditure. Debit that in the P&L, rates and taxes. So automatically nullified. So they are trying to come back and say, if you prepare a memorandum of profit and loss account for the item which has been included, there is an opposite claim which should also make it in the P&L. So it's a revenue neutral. Accordingly, if any of your clients are believing that I don't want to offer anything under section 45A, capital A or ICDS 2, refer the guidance note and say that the client is following exclusive method on a consistent basis, and accordingly with respect to the input credit taken on GST will not have any impact on the financial statement as per the guidance note issued by the Institute of Chartered Accountants of India. You can conclude that. That is the second option which is available. Only one caution is the assumption for the memoranda is 18 rupees when I am selling, I will anyway pay the tax to the government. So I'm debiting that P&L account, memoranda P&L account. Suppose if this stock is unsold out of that 100, even in the next year, when the returns are being filed, 50% of the stock is not sold. Okay. So 31st March 22, September 22, 50% of the stock is not sold. I debited this item as rates and taxes. Rates and taxes covered under section 43D of the Income Tax Act. Any tax, duty or other sum, if unpaid before the due date for filing the return of income under section 139(1), will be disallowed and will be offered as an expenditure only in the year of actual payment. So 18, you cannot claim, 9 will automatically be added to that. You have to add it, right? Only that element alone, you have to be careful. If there are unsold inventory, even after the year end, till the sorry, till the due date for filing the return of income. Okay, that is the only worry which you have to have with respect to your inclusive and exclusive method. Otherwise, nothing to worry too much on this. Now, suppose if it is there is a, because we are talking about non-corporate entities, we should also say what would be the issue when we are talking about dissolution of a firm, AOP or BOI, and what is the prescription given in ICDS? So in a normal scenario, when dissolution of partnership is happening, dissolution of the firm is happening or AOP is happening, when I distribute dividend, the amount to the partners or the members, what I normally try to do is what is the value of the closing stock? That's what I will do. But here what it says in respect of dissolution of firm, AOP or BOI, ICDS says you should take the fair market value on the date of dissolution and consider that as a closing stock. In other words, they are trying to take the tax well in advance on the basis of fair market value on the date of dissolution of the firm or AOP. That is an additional consideration because we are talking about a non-corporate entity. Change in method of valuation is only when it is sufficient cost, nothing to worry. Now comes the ICDS 3, construction contract. There are two possibilities. Your client will not have the business of construction contract. They are into the business of trading. Absolutely, the standard is not applicable. A7 is not applicable. ICDS 3 is not applicable. All the worry which we will be having in this is also not applicable. But if your client is having this construction activity, there are few items which are little contradictory with AS7. For example, the AS7 still prescribes that there is a possibility of you using completed contract method. And in a non-corporate entity, especially for a proprietor or a partnership firm, we offer the income on the basis of completion of the contract. Now it is not possible because completed contract method has been prohibited. You have to offer your income based on percentage completion method. So if any of your clients in your list is still using this as an accounting policy in the non-corporate sector, you have to particularly careful to quantify that number and take it forward. This is an interesting factor on retention money. I will discuss this in the next slide, or maybe 2 slides after this we will discuss, because this is a interesting guidance given by the institute which a lot of people can follow. We will consider that a little later because it requires a little bit of extra discussion. The next important point is, if you see AS7, I have agreed for the initial contract specification. There is a variation in the contract. Client has asked for some additional changes or modified some of his existing requirement, which makes me to bill additionally to him. Similarly, I made some claim for losses incurred and there are some incentive for reaching a milestone. So I completed yearly and they are ready to pay some amount, etc., etc. Here, the contract revenue includes variation, claims, and incentives. Only one problem which we are having is that in respect of our construction contract, it says unless there is a certainty or it reached the advanced stage, you should not include as part of contract revenue. Whereas here they are saying it should be included in part of the contract revenue, means your income will be higher in the year on which there is a variation claim which you have made, even though you have not got it approved. You have to offer that as an income. So that is one thing which you have to keep. Combining and segmenting contracts is only accounting aspect, nothing to worry too much. This is what I was trying to mention. Uncertainty of collection, not the basis for deferring claims and incentive. Advanced stage means there should be a possibility that I will be able to collect it, reasonability of collection. But there is an uncertainty of collection, means A7 allows you to defer that income till such time that uncertainty is removed. But unfortunately, here they are saying that you offer it, if it is not realized, claim that as a bad debt at the year in which it is not realized. So that is the way in which they are coming up. Another point is, contract revenue cannot be deferred if the stage of completion exceeds 25%. It is also directly connected with the completed contract method. Sometimes people will say, I don't know whether I will end up with having profits or losses. So I will simply consider them as a WIP and I will not offer any income. But what it says is, if the construction revenue, which I have to offer for taxation, if the stage of completion of the project is exceed 25%, again, the question which comes to us is, the moment we are talking stage of completion of 25%, land is purchased which cost around 80% of my total project cost, 20% is my construction cost. 80% is already incurred, whether I have to offer income? No. Stage of completion of the construction. So the construction related cost, what was projected and what is incurred, is it crossed to 25%? Then you have to necessarily offer percentage of completion method basis the revenue on the construction contracts. Foreseeable future losses, that's what I was mentioning. Your ICDS 1 as well as in ICDS 3 and ICDS 4 also they have covered. Suppose if the contract revenue could not be collectible in the subsequent years. See, for example, I have estimated my revenue. Original contract revenue initially estimated to be around 120 lakhs. Let us assume that for a from partnership in respect of contract A. Next year, I know that around 120 lakhs which I have claimed, there is a possibility of the party will reduce it by 10 lakhs. So as per A7, my contract revenue will become 110. And then I have to apply all my percentage completion on 110 only. Okay. Whereas here what they are saying is, you cannot claim 110 straight away like this. You cannot reduce the 10 straight away in the year. But you should claim on a 120 you have to retain on the same basis. But what is not collected based on a reduction which has happened, charge it as an expenditure in the year in which it has been incurred or it is uncollectible. My worry on uncertainty of collection, not the basis of deferring the revenue, and contract revenue uncollectible in the subsequent years, but you are very generously saying that you can claim that as a bad debt. What are all the evidences you will ask me to prove that it's a bad debt? How I will be able to prove that? How long it will go on dragging? That is the only worry which I am having. Otherwise, there will not be any issue relating to this if they are allowing me like that. Now comes the retention money. Mainly for this, I specifically talked about the interplay between accounting standard and the ICDS. What we have said, income computation and disclosure standard can say how you have to compute your income. Let us take a case of a company which is carrying on, not company, non-corporate entity which is carrying on construction activity. Construction contracts are carried out. That contract says the value of the contract is 75 lakhs and 10% will be retention money on all your running bills. The 10% retention money will be paid only after completion of the warranty period. The warranty period as per the contract says after the completion of the contract 3 years. So assuming that the contract is expected to be completed in 31/3/2023, 24, 25, 26. Only in 26, the company will pay me. Company, I'm saying, is a contractee. Company will pay the non-corporate entity the retention money after ensuring that there is no quality issue, there is no issues relating to the terms and conditions which I have complied with, etc., etc. Then only the payment will be made. So the question came is, when retention money accrues as an income in the hands of the assessee, this is the question. When it is accruing as an income in the hands of the assessee, the worry which we are having is that various judicial pronouncements are said, because you have a condition attached with recovery of the retention money and you have not yet fulfilled that condition 3 years after the completion of the contract, that is 26, you cannot say it accrues in the hands of the assessee on the day of entering into the contract. I have seen cases where even companies, I'm saying even companies, they have offered total construction revenue including retention money as per the accounting standard. For Companies Act, there is no exemption available. But for non-corporate entities, we can still apply this principle. When I say it is not accruing as an income, I need not add it as part of my total contract revenue. So I will consider 75 lakhs minus 7.5, that is 67.5, on which whether I have completed 50%, then I will offer 67.5 means what? 33.25, right? 33.25 is what will be offered as the total revenue up to the current period. And there is no need to consider that 50% of the 7.5 lakhs according to the various pronouncements, because they say retention money accrues as an income only on fulfillment of the condition as per the terms of the contract. Now, ICDS has said revenue includes retention money. Contract revenue includes retention money. This is the one-line statement in one of the paragraph it says. So that means they are defining retention money is also income. Now we are coming to our core principle. Can ICDS define what is income? The court has said that not possible. The guidance note says it's not possible. And accordingly, if any of your client, non-corporate entities, are having the practice of not offering the retention money on accrual basis, but offering only on realization basis, still that holds good. Even though ICDS 3 is saying contract revenue includes retention money, these case laws are still applicable and they are all good, is what the Institute of Chartered Accountants of India has mentioned. Accordingly, if the assessee is not accruing it and offering it only on the basis of actual collection, you need not worry too much for ICDS, because ICDS can only define the computation method, but not define what is an income. This is a case of defining as an income. Okay, this is one important point. Then ICDS 4 relating to revenue recognition under your AS 9. Similar thing, no more completed contract, but in this case, sale of product means there is no question of completion of the contract, but sale of services, there is a possibility. ICDS actually gives one practical expedient where it says if the service contract will be completed within 90 days from the date of execution, then there is no question of you applying percentage completion. You can use it even after the end of that period. Percentage completion is permitted in respect of service contract which are going to be completed within 90 days. For example, if I am talking about a case of your client is carrying on the business of transportation and he has so many lorries. On 28th of March, 100 lorries have started carrying goods. They have not yet reached the destination. Whether it is required to identify where they are standing as of 31st March, midnight, 12 o'clock, nothing to worry, because if your destination is within 90 days or the contract for delivery is within 90 days, you can simply recognize it in the next year also. Nothing to worry, because ICDS also allows. This is something, is a positive aspect, looking at the practical side. Similar to what we have seen in construction contract, if there is a price escalation or export incentive in respect of certain thing, and you have an uncertainty of collection, what has to be done? This is a price escalation and exports incentive, and there we have talked about contract modification and incentives. This export incentive always a problem. For example, duty drawback. Or now there is one new case, new exemption which came in is road tax. In those cases, the client doesn't want to offer unless it is actually collected, because they are worried about, I made a claim, I'm entitled for it as per the scheme, but when it is actually coming in, I'm not very clear whether they are paying 100% of that or they are deducting something, and what is the reason why they are deducting something. So they normally believe there is an uncertainty of collection, and accordingly, they have a case for not offering that as an income on accrual basis, but only on actual receipt basis. Now, let us look at that, whether it is possible. It is not an accrual basis of accounting, it's a cash basis of accounting. You cannot have accrual basis and cash basis of accounting the moment you are subjected to audit under any law and you are supposed to comply with all the accounting standards. Now, this export incentive, because of the uncertainty which you are having, you don't want it to offer. One of the cases which has been referred to me, where the auditor was very particular that there is no exception available, even if there is an uncertainty, you have to offer that as an income. That is the way in which an auditor of a PSU has considered. We have looked into that particular case and identified that the way in which the company has returned the accounting policy is an issue, but the way in which they have actually accounted is not an issue. What they have accounted, if the uncertainty is removed, they have accounted it. But the way in which they have returned the accounting policy, this is accounted on receipt basis, where that problem started. So then we have suggested no need to change it, because AS 9 also says, and ICDS 4 also says, if the ultimate collection of an incentive is uncertain, you need not offer that as an income. You can defer the revenue. So concept of prudence, to some extent, ICDS is also considering that. So if your accounting policy is saying that exports incentives are accounted for all exports subject to the assessment of their ultimate collection. So when you are writing it, indirectly you are communicating. If it is uncertain, you are not offering. If it is certain, you are offering. So that is the way in which we have suggested for them to make the changes, which C&AG has also accepted and the auditor has also accepted. Finally, that got clear. But the uncertainty cannot be for deferral of your interest and royalty income. Assuming that one of your client has developed a technical know-how and he has given the technical know-how to be used by another party for which royalty income is supposed to come. But the other party is not paying it regularly. There is always an issue of chasing, collecting, etc. So client doesn't want to make the payment on the unrealized portion of the income. Only when it is collected, they wanted to offer that as an income. The royalty will be offered as an income. Unfortunately, ICDS 4 says you cannot defer royalty income even if there is an uncertainty of collection. So accordingly, there will be a difference between these two. Interest on refund of income tax or any other tax, duties, cess, etc. will be taxed in the year in which it is received. This is the reason why now everyone is trying to look at 26As. In the 26As, if there is an income tax refund, it automatically gets covered there. And they are also mentioning what is the interest on that. So the assessee, by passing a wrong entry, by reducing only the advance tax and not offering as an interest income, will get caught. So this is one thing which we have to clear about what we have to do. As far as the dividend income is concerned, that is not covered by your normal business income, but income from other sources is also covered by AS 9, revenue recognition. ICDS 4 says dividend income has to be dealt with as per the Income Tax Act. So accordingly, dividend income in the hands of the assessee who is receiving it will be taxed. So, and also subject to withholding tax or TDS when the company is making the payment to the non-corporate entity or any other shareholder. So accordingly, dealt with under the Income Tax Act. Now you may ask a question. I'm talking about ICDS 1, 2, 3, 4, and now I'm skipping ICDS 5. The reason why I picked up is for two reasons. One is the time within which we have to complete it. We have to concentrate on specific issues rather than going through the irrelevant portion of certain items. That is the reason why ICDS 5 is not considered. When it comes to foreign exchange rates, AS 11, two important principles. If I have borrowed money for import of capital goods, still under 43 capital A, it should be capitalized. Whereas as per AS 11, it should be charged to P&L. There is no question of capitalizing it. Previously, there was an option available to capitalize. Now it is not possible. So these exchange rate differences arising in respect of import of capital goods should be covered by section 43 capital A, ICDS 6 is talking about. This 43 capital A, I don't want to complicate too much. I will just make it very simple. It talks about import of capital goods for which you have taken foreign currency loan. If you have taken a foreign currency loan and used it for purchase of asset locally, then 43 capital A is not applicable. If 43 capital A is not applicable, whether that can be claimed as an expenditure, unfortunately, the courts have held that it is a permanent disallowance. You cannot claim it. Under 43 capital A, at least it will go to the block of asset and you can claim depreciation over a period of time. Again, 43 capital A talks about the exchange rate differences which are realized. Unrealized should not be taken into consideration. See, for example, I am restating the loan. It is not actual loss which I have incurred. I am only restating on an accrual basis. That is unrealized. Whereas I paid a portion of the principal on which there is a loss. Because I got the loan when the dollar price was at 65. Now today it is somewhere around 79. The 14 rupees difference I have paid out from my pocket. That payment or on settlement or realized losses can be added as per section 43 capital A. The question is, supposing it's a gain, what we have to do? It has to be reduced from the block of asset. So normally we miss out for non-corporate entities, not only non-corporate entities, even for companies, we will miss out this. So please be cautious of this particular aspect. The second principle is that there is a concept called borrowing cost, where it says, I took a loan in foreign currency where the rate of interest is 3%. The forex loss is 4%. Put together 3 plus 4 is 7% is the total cost which I have incurred on taking the foreign loan. If I take the similar loan in INR, I have to pay the bankers 9.75%. So it asks to compare the effective rate which you have incurred for a foreign currency loan with the effective rate for a normal INR loan. If the INR loan is higher, then the exchange rate difference is considered as part of borrowing cost as per AS 16, as per AS 11. In both the cases, they are saying it is an adjustment of a borrowing cost. That's paragraph 4E of AS 16. Okay. Unfortunately, ICDS 6 read with the ICDS 9, if I'm not wrong, on borrowing cost, they are making it very, very simple that no such treatment is available. The entire forex difference should be considered as a forex difference. So that means you have to treat that only in accordance with ICDS 6, and you cannot go for considering that as a borrowing cost. So the only on realization basis you may get it allowed. FCTR and forward contract, nothing to worry too much. Government grant, only one point which I have to talk about is basically when you receive a government grant. When you receive a government grant, when I'm saying I'm entitled for a grant from the government, I made an application. The application is favorably validated and they have issued me the payment. But the payment comes along with certain conditions to be fulfilled. If the condition is not fulfilled, I have to refund that particular grant. So in that case, our accounting standard says, unless the conditions have been satisfied, you cannot accrue that as an income. But ICD 7 says, you cannot postpone recognition of a grant as an income beyond the actual date of receipt. So I have already received it, even though I have not actually fulfilled the conditions, still I have to pay tax on this. Now the question comes, subsequently I am not able to meet the particular condition. I am refunding the contract. As usual, ICDS 7 says, claim that as a refund of government grant like a bad debt in the year in which actual refund has been made. So pay the tax well in advance, claim it only in case if you are returning in a subsequent period. That is one principle. The second principle is that in accounting standards, still there is a method of accounting called capital reserve or capital subsidy. For example, if I am setting up a project, a partnership firm is setting up a project in economically weaker area or backward area. So the government says if you are setting up an industry in a backward area, you are entitled for 15% of the project cost as a capital subsidy. What we normally do is 100% of the asset will be capitalized, 15% will be shown as capital reserve because it is like a contribution from a promoter, but not to a specific asset. So we will do that. That's what we normally do, right? But no such approach is available under ICDS 7. It says any grant which you have received should be recognized on a deferred basis income over the period of the repayment or something like that. Okay. Now, refund I have already discussed. Another interesting factor in majority of the cases where I'm importing machinery, assuming that a partnership is importing a machinery, but there is an incentive available, export promotion credit guarantee. What do you mean by that? When I import under EPCG scheme, I need not pay the import duty, but I have to commit so much of exports I will achieve in the next 7 years. If I am not able to achieve, I have to refund the proportionate duty which I saved. But now here it says, even though EPCG scheme is over a period of time, you are saving some taxes. Accordingly, reduce the taxes from your particular asset in case it is an import of an asset, and consider the accounting as per ICDS 7. So that is one additional impact. Borrowing cost, okay, I'm fair enough to remember that number. It is ICDS 9 only, borrowing cost. Here everyone, I have seen that there is an issue relating to this ICDS vis-a-vis our accounting standard. And everywhere there is a misreporting or underreporting happening here. What is the reason? Borrowing cost is an expenditure incurred for when I took a loan from third party. Maybe interest, maybe processing fees, maybe a brokerage, etc., all inclusive cost. Not necessarily only interest. All are included. But that borrowing cost, is it a revenue expenditure or a capital expenditure, is always arguable position. What we argue, because it is only interest, how you can add it to the value of the asset? Okay. But accounting standard 16 says, if the borrowing cost is incurred in respect of a qualifying asset, then it should be capitalized. All other borrowing costs should be charged off. Simple. Let us look at ICDS 9. What it says, it also says the same thing. If it is relating to a qualified asset, it should be capitalized, or otherwise it should be charged off as revenue. So both are same. Why we have to worry? The problem is the concept of qualifying asset. I will come to the treatment of borrowing cost, disallowed, etc. under various sections. I will come to that a little later. Qualifying asset in respect of specific borrowing, the definition given in A16 borrowing cost says, an asset is a qualifying asset if it takes substantial period of time to get ready for the intended use. Meaning what? I purchased an asset, machinery, and the machinery is not ready for giving a commercial production. The date from which I have started in expenditure on that particular asset till the date on which it is ready for the intended use, that period I have to see. If it is more than 12 months, it is a qualifying asset. 12 months and above, and of course, near to 12 months is also considered as on a judgmental basis as per explanation given by the institute. Now the question comes is, you are talking about a qualifying asset which takes substantial period of time. So why I am trying to worry about ICDS 11? Sorry, ICDS 9. The problem is ICDS 9 start with the definition of qualifying asset like this. Qualifying asset means land, building, property, plant, equipment, office equipment, furniture, fixture, etc. and inventories which are taking a substantial period of time to complete. What is the difference between the original definition under A16 and this? Under A16, any asset should take a period of 12 months. Whereas under the definition of qualifying asset in ICDS 9, the definition is only, the 12 months period is only for inventory. For all other asset, 12 months cannot be applied. Now you will understand what is the gravity of the issue. Let me take an example. I started incurring the capital expenditure on 1st of April and I have completed in, say for example, 31st of October. 30th of September, 6 months is very easy for any calculation. 30th of September. Under A16, under AS 16, it does not have any substantial period of time. So it has to be charged to P&L. Whereas ICDS, what it says, property, plant and equipment is a qualifying asset. There is no 12 months attached. And accordingly, even for that 6 months period, whatever interest you have incurred should be capitalized under ICDS 11. So there is some disturbance. If somebody is to be muted, please mute. Selva, please mute.
Yes, sir. Yes.
Then comes qualifying asset is the first problem. But only interesting factor is it is applicable to only specific borrowing. That means I have taken a term loan for purchase of an asset. Then I have to apply that criteria. 12 months is only for inventory, not for others. Suppose if I have specific general borrowing, so many borrowings are there. I have used some of the borrowings for asset also, some of the borrowing for working capital also. In that case, it says 12 months should be applied for all the items. But normally in general borrowing, 12 months period will not be possible to work it out unless there is a capital liability, etc. So this results in an issue. And not only that, the commencement of capitalization will be earlier than AS, because AS is talking about some 3 conditions to be fulfilled, whereas here no such condition. The moment you started incurring the expenditure, it should be capitalized. So starting will be upfront. Suppose in between the project could not be carried out, there is an issue relating to that project, and accordingly I have to suspend the capitalization. Whether I have to do the suspension because it's a over, I'm having a over run time period, abnormal delay. Whether I have to capitalize, A16 says no, but ICDS says ICDS is keeping quiet. That means the moment you started incurring that,
financials review பண்ணாங்க டீம்ல லேட்டஸ்டா ஒரு 20 ஐட்டம் ஏதோ டிஸ்க்ளோஷர் போட வேண்டியிருக்கோம்.
Okay, so that should be capitalized. Is there any question which is coming in, or they can put it the question in the Q&A box?
Yes, sir. Yes, sir.
And similarly, capitalization ceases only when the asset is put to use. Whereas under AS16, it will be based on when the asset is ready for the use, even if it is not put to use. Okay, that is one thing which we have to be careful. Forex differences we have already considered. Now, what should be our approach towards this ICDS and this? Take the financial statement as per the accounting standard, identify whether ICDS is applicable, identify the difference between the accounting policy as per accounting standard and what is as per ICDS, quantify the impact in clause 13E, make the disclosure in 13F. Simple principle, right? Now, what is the disclosures required? What is the disclosure requirement in ICDS? ICDS is not for maintenance of books of accounts, and accordingly, there is no disclosure required in final accounts or in the financial statement. But ICDS requires a disclosure to be made in tax audit report. In the tax audit report 13F, if you are making the disclosure, everything is fine. But normally, you cross-refer the disclosures in the financial statement. So I suggest that put it in the financial statement and cross-refer that in your disclosure in 13F. And another point is, if it is not applicable to tax audit, there is no disclosure required at all. The disclosures are 2 points. One is a general disclosure and specific disclosure with respect to certain ICDS. And how you can do that, you can give it in the notes on accounts, or you can simply give it in your Form 3 CD. But when you are giving a notes on accounts, it's more clear because you can use it for any client, replicate it for other clients. And in case if there is a overriding, so for example, ICDS 2 is talking about you have to value your inventory inclusive of the duty, right? 145 capital A also talks about inclusive of your duty, your taxes. So 145 capital A comes in a different class. If I'm not wrong, it's class 14. Whereas ICDS comes in class 11, if I'm not wrong. Whereas ICDS is coming in class 13F. So where to put that? I normally prefer give it in ICDS by saying that this has already been referred in class number so and so, because there is a specific requirement under that particular class, so that you will satisfy both. This is another thing which you can prepare a separate disclosure and you can upload it along with that, the cross reference to the clause on 13F. So this is what a summarization of what is the general disclosure required in every case, almost all standard. There are specific disclosures required in certain ICDS that you have to take into consideration. So that brings me to the end of the session and the question and answer session. This presentation with my contact details will be anyway shared with the institute. I'm stopping the sharing of my screen. Any questions which you are having, I will be happy to answer.
So they can post it in.
Somebody was asking some questions relating some specific format or disclosure. Something was I was able to overhear. If that question comes in specifically, I will be able to answer.
Sure. Maybe they can put it in the chat box. I'll try to unmute everyone.
Yeah. Sir, I think somebody is raising their hands to talk.
We have given them unmute rights, and also you can see it in Q&A and chat box also for questions. In the meanwhile, just unmute it.
Okay, I stand corrected with respect to somebody 17 days for tax audit. I normally consider my own office internal deadline. We wanted to complete all our tax audit, including transfer pricing, by 30th September and be happy in October and November. So on that basis, I have given. Okay, if you have another for 30 days, happy. Any other questions, sir?
Questions? Yes, there are questions.
Okay.
Selva?
Rounding off applicable to non-corporate entities, sir.
Where is the question, Selva?
Q&A panel also you can see in chat box.
In Q&A, okay.
Hello.
Q&A, I have answered the questions up to the rounding off. Okay, here one new question is coming in. Is rounding off is applicable to non-corporate entities? Fortunately, no, sir. Fortunately, no. Because this came part of amendment to Schedule 3, which made it mandatory for all the companies. Even if you're having only 1 lakh rupees, it is a problem. Okay, but the issue which we are talking about here for non-corporate entities, that Schedule 3 is not applicable, and accordingly, rounding off is not mandatory.
Sir, I have a question. Actually, it is mandatory to file first the tax audit report and then after 30 days, we have to file the return.
Because there is a cross-reference which is coming in the return, no?
Okay.
So because you are supposed to give the date on which the TAR has been uploaded in the electronic format. So naturally, at least you have to first to do the TAR uploading. On the same day, you can do it immediately after that also.
Oh,
and
fine. We can file the return. So no need to give 30 days gap, is it?
Sorry?
No need to give 30 days gap for the
No. That is given by the act, but you can do it immediately.
Okay. So we have to file before 30th September, is it, sir?
I normally go with a simple principle, madam. Better to complete, bill, collect the money, enjoy. Don't continue to have the pressure for the next 30 days also.
Okay, actually, we have to file the tax audit report before 30th September, sir. If you are not filing, what will be the complications or what will be the what you can say.
You will
Enna-
have a
enna
penalty, na?
person, if you are not doing the tax audit report before 30th September,
You will have the penalty under the 44 AB. There is a penalty which says that 1% of the turnover or a maximum of 1 lakh rupees, which will be paid.
before, if you are not filing the report
Yes,
before
yes,
30th
yes, yes.
September.
That is
Oh.
actually at the discretion of the assessing officer.
Oh.
So the assessing officer will have the discretion to waive that if there is a sufficient cause. But
Okay.
previously, when we are going and representing the assessing officer, they may able to appreciate, but with the faceless assessment, I am not sure whether.
Okay. Okay, sir. Thank you. Thank you very much, sir.
Okay. One more question, which is talking about is, should LLP follow Schedule 3 guidance note or non-corporate guidance note, as LLP is a body corporate? Sir, this non-corporate guidance, they have said not applicable to LLP. Very clearly, they have mentioned. And for LLP, they have come out with some additional guidance subsequently, but I'm not gone through that because I don't have a LLP client. Sometimes even I read it only when there is a necessity comes. If there is an opportunity to talk on a LLP related financial statement, then I may do that. As far as my knowledge is concerned, you cannot apply Schedule 3. You cannot apply non-corporate guidance because they have said that it is a separate guidance which they are providing for LLP. And there is one more question in the chat box. Would it be right then to say that restatement of foreign currency assets and liabilities will be covered under ICDS and MTM will not be covered? Yes, because MTM is covered by ICDS 1 and the restatement of foreign currency assets and liabilities are covered by the ICDS on foreign currency. And there also specifically they have said that mark-to-market losses are not permitted. And because of that only it's a problem.
Are there any special disclosures to be made for the GST arising in the current 44 years? Any
Class 44.
nuisance for everybody?
Class 44, sir, with all respect to everyone and including the guidances which we have received, we tried even in our own case. My wife tried for 3 days to give to our tax auditor. Our firm is subjected to tax audit and she wanted to give to, as a partner, she wanted to give to the tax auditor, including the breakup. She tried, but I told on the first day itself, most likely we'll end up with having not available, certain information is not available. How you are going to satisfy the auditor is the question which I have asked, but she tried. And after 3 days, she said, still there are gaps. Then that is the reason why we have concluded in our office, we will ask the client whether they will be able to provide all the information required. If they are not able to provide that information, I will go with a disclaimer. 99.99% of the cases, I believe that the disclaimer as given by the institute in the guidance will be the better way of handling the situation. I believe that we will not have 100% exact tallying of that number.
Thank you, sir.
Questions, panel, we have 2 questions.
In case there are no other questions, I will hand it over to the Vice Chairman.
There are one question in chat. Sorry, question on panel, sir. Around 760.
H1A. 1 second. Let me see. Okay.
2 questions actually. One is by
what if TAR is filed and the 30 days has lapsed for ITR? Should TAR be revised? But frankly speaking, I have not encountered that particular situation because normally tax audit, the moment I upload the tax audit, immediately I upload the return also. Theoretically, let us assume that you have filed your tax audit report, but you have not filed your income tax return within 30 days. For non-filing of tax audit report, you will not end up with paying any penalty. For filing belated return, you will end up with paying penalty is what the consequential impact is what I'm saying. So whether TAR be revised, no way. I don't think that there is an option available for revising your TAR. Another question is, this is on rounding off of companies. Could you please clarify, should we use rounding off the trial balance, should we use 100 or 1,000? Sir, even though this is not relating to non-corporate entities, I will take one moment on this, Vice Chairman, because even today I'm getting calls from a lot of chartered accountants in practice. What is whether mandatory to rounding off the financial statement for companies? The way in which Schedule 3 has been amended, in the rounding off section, they have moved their word may be rounded off as per the following. The may be has been made shall be rounded off. That means it becomes a mandatory that you have to round it off. Only two things which they have given. What is your turnover? If it is less than 100 crore, you can go from 100, 1,000, lakhs, crore, etc. They have given. Sorry, crores is also not available if I'm not wrong. But if it is more than 100 crore, they have millions is permitted, but not crores. When you are having more than 100 crore, they are saying you cannot use hundreds and thousands. You have to go with lakhs, millions, crores. So the question which people are having is, what do you mean by round off? Let me take a number. 12 lakh 24,255, 12, 24, 255. How this amount has to be presented? Let us assume that I am opting lakh rounding off. I simply tell them, have your trial balance, or maybe in your financial statements, have the columns with full figures like what you are doing for every year. And then insert one more column for the current year and one more column for the previous year. And the current year column in the notes, subschedule, for example, capital, you have fixed assets, etc., etc. There you round off the full figures by giving a formula, full figure number. Anyway, that number you require for the book purposes. So you retain that is equal to full figure divided by lakh. Right? Divided by lakh means 1 lakh. Now the question is, rounding off means I should normally don't have a decimal, or it should be only lakh. 12 lakh 24,255. When I am saying it should be 12 lakhs only, or 12.26 lakhs. Sorry, 12.24 lakhs plus that 12.24 lakhs. Whether I have to put that number. The option when we are talking about, if you read that, it says hundreds, thousands, lakhs, millions, and are decimals thereof. That means you can have 12 lakhs alone or 12.24 lakhs also. Both are available as an option. Preferably 2 decimals is a better option for us. Okay. So that is the way in which we do. For a very small company, when you are doing this rounding off with with lakhs or millions, the number will be becoming 0. And accordingly, in that case, think about using thousands, because thousands is a simple way of understanding. After this number, you have to only add 3 zeros. You will know what is the number, full figure. On an imaginary basis, you will know the full figures also. For smaller companies, I will suggest that. For example, he is talking about 15 lakh 10,152. If I am rounding off based on lakhs, I can provide 15 lakhs 0.00, or 0 columns also I can avoid in the financial statement, or I can put 15.10. Both are permitted. Rounding off doesn't mean that I should not have a decimal point. Whether I am permitted to use 15 lakh 10,152, not at all permitted. I have taken an example of dividing with lakhs. If you wanted to present in thousands, 15 lakh 10,152 divided by 1,000 will give you 1510.15. Right? That is a simple way of doing it. So please understand that it's a mandatory, even if, because I have seen cases where some people have said, I have completely gone and finalized this because it's a subsidiary of a foreign company, and I have signed a full financial statement with full figures, and I have issued the audit report also. Now I understand there is a rounding off is required. I said that no problem, let that be also there. another financials with rounding off, get it signed on the same date, explaining that this is a mandatory requirement. This is a problem not only for the auditor, but also for the company, so company will accept. In case if you have already done by mistake full figures, get one more thing done with the rounding off. So that is on rounding off. Whether the revised format of financial statement is mandatory, not at all mandatory, sir. It's only optional. You can decide whether you will have time to do that or you wanted to avoid this for the current period. My experience says that if you use it, it helps to comply with all the standards. But because of the time constraint and the manpower availability, you can decide. It's only recommendatory according to the guidance. What are all the matching areas and cross-verifiable areas in 3CD and ITRs? Avinash, sir, that means I have to prepare a complete list for all the classes. So I can only give an example. For example, your related party payment to related parties, profit sharing ratio, and then loans and advances, 269SS, 269T. And one more thing which we normally talk about is all the ratios. There is a cross reference with the financial statement you have to do because the numbers are flowing from that. And one more point which normally we miss out is that there is one clause which is talking about what is the input credit taken and how it is utilized and what is the accounting treatment for the balance at the end of the year end. The balance at the end of the year end should match with your your input credit as per balance sheet. The way in which you have adjusted should match with your GSTR returns and whatever input credit where you have availed. So that you have to do that. So these are all examples which I can do, but for each and every class, if you are going on checking it, maybe you will have an answer. This time I'm not able to do that. Maybe I will try to do that as one exercise and share that at a later point of time for others. But it will take a little bit of time because I'm also having some pressure on tax audit completion. The next question is from CA Ala. Audit report has to be filed before 30th September and return has to be filed before 31st September. What is the purpose and why? Income tax department wanted to cross-verify the numbers, sir. Data analytics is what they wanted to use it. That's the reason why they want this timing. So that's the only reason why they are having it, is my view. But is there any other hidden reasons? I don't know. So,
Sir, we're done.
that's the end of the question, sir.
Yes. And that's over to you, sir.
Over to Vice Chairman, sir.
Yes, sir. Yes, sir. Thank you very much, sir. Despite your health issues, you have taken up this challenge, and also tax audit issues. So everyone is having challenge. You are having much more bigger challenge in completing the task before the deadline. So you have done more than justice. I could not miss even anything out of your this one, but for attending one or two calls, I completely followed your presentation. It was so lucid and more useful and very alerting, and you clarified most of the doubts that were there, and most of the presentation was self-explanatory. So the number of questions were also very less. Thank you very much for your time and presentation on these days. Thank you very much. And I thank all the members who have participated and made this within a short time, despite the what's called communication not being so well done to the members in this case, because of so many hurdles in fixing the dates. Despite that, you have already attended and also made use of this conference, this webinar. Thank you very much to all of you. I also thank Mr. Selva for being technical support for this webinar. And also I thank in absentia my chairman and secretary for taking up my request on this topic, which I feel very, very important, because most of the small and medium practitioners in smaller places will not give that much of importance, as you rightly pointed out, sir, because the time pressure. I made a remark in the initial stage itself. Most of these members know all the accounting standards, they adopt it. But while making disclosure, that is a challenge, and electronic upload is the another challenge. So because of that, we cannot take any lenience on that. So I wanted to do this, and many members have already, they tried to register today. Unfortunately, it was not possible because it started yesterday only. And they want this recording of this also. And we will upload this on the YouTube at the earliest. So thank you very much to all of you for making this a very useful lesson. And the third session is on 15th evening, 5 p.m. So please do attend and make use of this. And I'll check whether the third session alone is there any provision for registration and attending the webinar. Thank you, one and all. Thank you, sir.